Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Gold blew off to a big new high. The dollar never came down and made a new low below 70 on the U.S. dollar index. That was very, very important. That piece of correlation told you something, again, that there's some background support for the dollar here, and the concern wasn't just U.S. based. So that's the point I was trying to make, or thinking of making. This is something else we were watching, and we sent this to our clients. What day did we send this out? We sent this to them on the 17th. And again, if this was going to be a risk appetite moving back into risk aversion, which currencies would be most exposed? One of them would be obviously the Australian dollar, because the Australian dollar, of all the major currencies in the world, moves the most on risk appetite. It moves the most on optimism. That optimism reflected in a new high in U.S. stocks and a new low again in volatility, that complacency. Look how much they bid up the price of the Australian dollar relative to the commodities index. This is what this is on the bottom. This is the CRB, or the commodities index, in black. Usually pretty tight moving together. A little bit of a divergence there, but not pretty tight. This is a real optimism here in China and Australia as the Chinese satellite, but it's not being supported by the CRB, which suggests to us that the underlying fundamentals, again, are a little bit out of tune with the complacency or the optimism when you just use it as, look at the currencies. This is a big divergence, very, very big. So if we were right about what was going on with the euro, and we thought, and if gold would break and stocks would break on it, what currency classes would break the most? Those that move up on risk appetite are the ones that break the hardest when we get risk aversion. So we wanted to be short something in the commodity currency area, whether it's the Australian dollar, Canadian dollar, New Zealand dollar. We happen to choose the New Zealand dollar. At times we wish we had the Aussie. We were happy with New Zealand today, sitting on a New Zealand dollar short and doing pretty well today. So that divergence setup, kind of confirmed, again, a little bit of the other stuff we were looking at. So that really was the thought process behind some of these trade setups, and that's exactly how we use them. These are charts that we sent out before the fact. Again, no holy grail here, and a lot of thought, or just not a lot of thought, at least just some basic logic applied. That's really the point I want to get across here. Look at these relationships and start thinking about them. I think it'll help you be a better trader, I guess, is the bottom line. We look at Nikkei and the US and the Japanese yen very, very closely. As you can see, this is a daily chart. The red line is the Nikkei stock index, Nikkei 225 stock index. If you're not familiar with that, that's kind of like their S&P or their Dow, so to speak. And the black line is the U.S. dollar, Japanese yen. As the black line goes down, obviously the yen, it takes fewer yen to buy one U.S. dollar. Therefore, when the black line is going down, the yen is strengthening relative to the dollar in this chart. You can see how tight this correlation has been. Even if you look at a weekly basis, it's pretty tight. A little bit of divergence there, a little divergence. And all of a sudden, we're getting a pretty big divergence in here. We're getting Nikkei stocks off and the Japanese yen starting to, turn over. And again, it's another one of those divergences. So we see a big divergence pretty much at the same time with the Australian dollar and the CRB and the Japanese yen and the Nikkei. And this makes some sense from the standpoint that investors were getting complacent and fairly bullish again in the stocks. But we're not seeing it in the currency. We're not seeing the Japanese yen follow. So again, it was another piece of that puzzle that said this divergence may be telling us that there's some risk appetite out there. The yen otherwise should be weakening if everything's hunky-dory in the world. The reason this relationship works, as I said, this is a logical economic relationship because of the fact that there's a lot of people with a lot of money and a lot of savings in Japan, less so than they had, but institutions insurance companies and others have a lot of money that they have offshore because they want to get higher yields. Makes sense. They pay very, very low yields in Japan. But when there's risk in Japan domestically, which is reflected in a falling stock market, these people that have money offshore, individuals and companies and institutions, tend to bring money back home. That just happens on risk. So they create their own carry trade. They bring money back home when things get risky in their own economy. So you see that tight correlation between a falling stock market and a rising yen. That's money coming back into Japan from all those players domestically that have money offshore. So that's the economic relationship that's logical and has made sense, and it's in place. So when you see a divergence setting up in here, you start to ask yourself questions because, again, the yen is a very dominant funding currency in the world. Anytime there's a breakdown or a divergence between this that has been very tight in the past, just sit up and take note and start to ask yourself questions, and that's how we use it. And that's why we look at Nikkei of those stock markets up there. Now I can see why that's one that we look at every day, and we look at it against the Japanese yen. There's some other decent correlations in treasuries, often fairly tight, the 10-year and the Nikkei too. You can play around with these things, and again, you don't need to get crazy and have a million different intermarkets to look at. Just get a handful that makes sense, some of the biggies, and you'll start to see this stuff, I think, as you just start to overlay these charts and think about them. You'll be surprised. It's not as hard as you think. We do this every day, and I may be talking fast through this, but it's not as hard as it may look if you haven't done this before. Just start looking at a few of the major ones, and I think you'll see it. Last point, we shared this with our clients yesterday, and we've shared this whole idea of the current account deficit in the past for many years. There's a lot of nonsense talked about the U.S. dollar and the current account deficit. In general, there isn't a real tight correlation in the long term, but there is a major macro driver correlation, a multi-year correlation, I think, with what happens in the current account and what happens with the U.S. dollar. The point I made earlier, and this comes from a guy named Triffin's Dilemma. Back in 1959, an economist wrote a book and said if the U.S. Takes over the role as the world reserve currency, replacing gold, it's going to force the U.S. in the chronic deficit situation on the current account because they have to fund the globe. So when you think about it in those terms, and everybody gets so upset when they see an increasing current account deficit, as we saw here in the U.S., this represents U.S. dollar credit, money going offshore. So it was pumping up all those asset classes out there around the world because it's the world reserve currency. It plays that role. And of course, when we had the credit crunch, things have changed in a big way, and we've seen a massive improvement in the current account. What's interesting is the U.S. dollar has bottomed, and right in here in March, and is rallying, and we're seeing a massive improvement even though the dollar's rising in the current account. Most economists who know nothing about trading or nothing about the dollar always said that the U.S. dollar has to fall 30, 40, 50 more % in order to balance the current account. Total nonsense. The current account is improving dramatically because we have a sea change in the global economy in terms of U.S. credit going out in the world. So this represents a big reduction in the supply of U.S. dollar-based credit leaving U.S. shores, so to speak, if you look at it that way. U.S. consumers are saving more. They're changing their spending patterns. They're still deleveraging on debt and dollar-based credit going on from around the world. This is very dollar positive. Again, it's not a direct correlation, but often it is a trigger for future moves in the dollar on a multi-year basis.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.